Hi, my name is Stuart Weems and welcome to the Investopoly podcast. My goal is to share easy to understand, evidence-based, holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. First question is from Liam today. Liam writes, thank you, Stuart, for generously sharing your knowledge. It's greatly appreciated. I look forward to the podcast every Tuesday. Can I please submit a question? My wife is 45 years old, has 200,000 in super and plans to continue working for the foreseeable future, 10 plus years. Her super is with Hostplus and we're trying to decide whether we choose between the high growth option or the indexed high growth option. There's a significant difference in fees, 0.8% versus 0.04%. So that's 80 basis points versus 4 basis points. There's a huge difference there in fees. What would you choose between these two investment options? My answer, I've answered this question before, in fact last week in the Q&A episode, and actually what I might suggest is refer to episode 380. And I think that 380, I talked about, developing an all-weather portfolio and using a variety of different index approaches to try and mitigate some of the risks and downfalls or shortcomings, I should say, associated with market cap indexing. And we just think very carefully about market cap indexing. The top 5 stocks in the US now make up 30% of the S&P 500 index, and Nvidia, the number one stock, is 8% of the index. Now, it's true that these stocks have been delivering significant earnings growth. So it's strong earnings growth, but there's certainly been multiple expansions, so in terms of valuation. So we need to really think carefully about that because 75% of your money is going to go into the US market, and of that 75%, 30% is going to go into just 5 stocks. We know that long-term history shows us the top 10 stocks globally change from decade to decade, and it's likely, particularly with technology, one of the risks to my mind with technology is that advances in technology could result in one of these companies becoming redundant or at least losing its pricing power and its growth power, and that's a real risk. Unlike, say, Apple, for example, that has a brand, it's a technology business, but it's got a consumer brand that's attached that technology, so it's not just the technology piece. Now, I know Nvidia has a ecosystem that sort of wraps around their customers, so they can't really easily go anywhere else at the moment, but we just know history tells us it's not a great outcome. Look, the other thing too, and I've mentioned this before in the podcast, is that running an index portfolio isn't as simple as you might expect it's going to be, and what you want to do is achieve a performance that's in line with the index. Now, that's difficult to do. It's less difficult to do for someone like Vanguard that runs trillions of dollars and has trading desks around the world and actually has, 50 decades of experience of running index funds and reducing the cost drag associated with the trading element. It's yet to be seen whether the industry funds just aren't going to do as good as Vanguard in that space. So what is that index drag? Time will tell. In fact, they don't really have that much transparency around these sorts of things necessarily, and so it might be difficult for us to tell. Anyway, that's my view. So I would go high growth, even though I'm paying 80 basis points. It's a lot to pay. I agree. Let's hope that there's a little bit more pressure on these growth investment fee levels, but I would pay the extra 0.74% for lower risk and most likely higher returns in the future, although it does depend on their active management, of course. Okay, I hope that answers your question, Liam, and hope that it's helpful. Okay, next question is from Matt, and I'm just going to paraphrase. Matt's question's really about planning your future in the face of uncertainty. Matt is training to be a surgeon and has 2 properties, one a home in Brisbane and then a property in what's described as a tightly held beachside suburb. Both have done pretty well. Bought the home in 21 for $810, currently worth 1.3. The beach house purchased in 23 for $950, worth 1.2, and that one's rented out. All loans on interest only, putting money in offset account, which is fantastic. The thing that Matt's wrestling with is that he doesn't know where he's going to live long term. That they're relatively keen on the idea of moving to Melbourne where his wife family lives, if he can get a good job post finishing training. However, they might end up staying in Queensland, and the forever home is unaffordable today. It's going to cost between $3 and $4 million, but when he qualifies as a surgeon, that'll become a lot more affordable. And he's going to have a bit of a dip in income over the next 12 months because his wife's taking some parental leave. So he's really wondering what to do in that scenario. It's a really great question, Matt. The first thing that I would really think about is, does the person have exposure to a property market, and how will that property market perform between now and when the uncertainty reduces relative to the market where they may want to purchase in? So to actually put some specifics around it, I'd be thinking, if you didn't have those properties, I'd be thinking, okay, we need some property exposure, because of course Melbourne could increase significantly over the next 5 years, and the property that you might, that you want to buy in Melbourne could end up being a couple of $1 million more expensive 5 years from now than what it is today. And you've got to pay that from after-tax dollars. That might still be doable on a surgeon's salary, but it's not economical. So really, the way I look at your situation is you've got two good assets. I'm not familiar with the beachside location, but Matt shared the address of his home. It's in a good suburb, so in Brisbane. So you've got exposure. These assets have been working. I think the Brisbane market, I've said many times, I think will continue to benefit from positive sentiment leading up to the Olympics. So that's 2032. I've said before, I think Melbourne will also enjoy a resurgence. But the timing of that is of course uncertain. Look, I think it's going to happen in the next 2 years, but will it really kick off next year, or will it just be a sort of a slow burn in terms of building momentum? No one really knows. I'm not sure. I don't really have an opinion on that. So in your situation, I think the best thing to do is do nothing. The risk is that you buy in Melbourne, or you try and buy in Melbourne, although that's going to be challenging, as you've already alluded to, with borrowing capacity. So then you might end up making compromises. So you can't buy your sort of forever home, in inverted commas, in Melbourne at this point because of financial limitations. You certainly wouldn't go and sell either of the Queensland properties to buy in Melbourne because you're not absolutely certain you want to move to Melbourne. If you were absolutely certain, that's something I would think about. It's an option, but it's certainly not unless you've got that complete certainty. And it also, even if you had the capacity, it doesn't necessarily make sense to go and buy your forever home in Brisbane either, because I would do that if Brisbane was just on the precipice of a new growth cycle, but it's not. It's been in this growth cycle since 2018, so it's sort of 7-ish years into a growth cycle. We know they tend to last 10 years. Brisbane's probably going to last a little bit longer because of the Olympics and the positive sentiment around that. So you kind of missed the boat, I guess, to sort of sell Enoggera and then buy in spend $3 to $4 million, buy in a better suburb. And I'm not saying miss the boat. You've done well. You've made some property decisions. You got into a growing market. It's already served you from an equity perspective. So we can tick all those boxes. So therefore, I think in your situation, we've got too much uncertainty to really make a big asset decision. And I don't think not making that big asset decision is such an issue in your situation, because you've already got really strong exposure. What is that? Nearly sort of $2.5 million worth of exposure to a market that, yes, it's getting closer to the end of the growth cycle rather than at the beginning, but still has some steam left in it. And so the likelihood that there's going to be a huge growth differential between, say, Melbourne and Brisbane over the next 5 years, I think that's still a risk, but I think that risk is greatly reduced. So in your situation, I think your approach is bang on. Accumulate as much cash in the offset as possible to prepare for a home upgrade. Put it in the offset so you're preserving the tax deductible nature of the debt. And then, work out in the future, you don't need to work this out today. In the future, you can work out, what do you need to do to make that move in terms of buying your forever home once you work out whether you're going to stay in Brisbane or Melbourne. And if it requires selling both those properties, yes, it would be better to hang on to them longer term. But, sometimes it's a necessary consequence. And sometimes in these situations, I will go and sell the asset to reduce non-tax deductible debt because it can really have a substantial drag. Although there's some some home loan structure strategies that surgeons can typically utilize, particularly if they do a lot of private work, to accelerate the repayment of a home loan. So anyway, that's another Q&A for another day. But hopefully, Matt, that gives you a sense of kind of the way I would approach that question, and hopefully it helps other people that are in a similar situation to Matt. So thanks so much for the question. Okay, next question is from Owen. Owen writes, I really enjoyed the podcast, by far Australia's best financial podcast, with most considered, pragmatic and non-sensationalist opinions. Keep up the great work. Thank you so much, Owen. You know, I really pride myself on making sure that I'm not sensationalist. I'm really focused on long-term outcomes, not what is popular at the day. And it sort of conflicts with, getting media. So, for example, I'm on the Australian podcast, the Australians Money Puzzle podcast, a few times a year. You've got to come up with something that is timely, newsworthy to talk about on that podcast. That's just the nature of media, of course. Whereas my blog, I think, is the antithesis of that. Hopefully that the blog that I write today is just as relevant as 5 years from now, which is not very popular because of course, the media writes about things that are popular, topical, controversial, all those sorts of things either appeal to fear and greed, but my podcast doesn't. Anyway, it's great. I'm glad everyone appreciates it, even though it isn't necessarily the topics that might be the best clickbait. Anyway, I appreciate, Owen, your feedback. Okay, Owen's got a couple of, I don't know if you describe them as questions, but really statements or observations that I think he wants me to share my feedback on. So the first one, and they're both, sort of related, I guess, but two independent ones. The first one is, when choosing an investment and considering whether it would be a useful starter home for my kids in a few decades, it's reassuring to have something in the bag for them, so to speak. This is a little contradictory, as most growth in investment grade property is not necessarily where you want to live in 20 years, maybe. It also limits the ability to cash out unless you can open up a line of credit on that property for shares or something else. So I guess I've got to read into, what Owen might be getting to here. I think the thing is, in terms of buying a property for my kids, it's a really common desire that people express to us, and have expressed to me over the last sort of 20 years. I've got two kids, I want to buy a couple of investment properties, therefore I've got one each for them. Or I want to buy an investment property in this location because I think my kid's going to go to Melbourne Uni or a particular university, and so they can live in it. I can rent it, but they can potentially live in it down the track. All those sorts of things. Look, they're good things to kind of think about in terms of a little bit of icing on the cake, but I just wouldn't ever advise, or I would caution people of taking into account these considerations, these lifestyle considerations. The best thing you can do for your kids in terms of helping them into the property market, or helping them, teaching them about money and investing, or making sure that, you're going to have a legacy to leave behind when you pass away, and some inheritance or early inheritance, all those things, the best thing you can do is make the best financial decisions for yourself. So in that regard, if you're of a mind to invest in property, invest in the best asset that your budget will allow you to buy, the highest quality asset that your budget will allow you to buy. And then if it happens by coincidence that your child wants to occupy that property in the future, fantastic. But don't premise the investment on that basis. In fact, don't let any of those things influence that decision. Ultimately, because if you make the best quality, the highest quality investment decision today, in the long run, that's going to help you build wealth, hopefully build more wealth than you need for your own retirement, and therefore put you in a position where you're going to be able to help your kids. And that's the best thing that you can do. So I would really caution people from thinking, I need two properties because I've got two kids. Firstly, children are going to grow up differently. They're going to have different goals and what's important to them. They're going to buy property at different times. Someone's going to be an early starter, maybe one child's a late starter. You need the flexibility, and you can't just go one asset. Those properties might grow differently, all those sorts of things. Just make the best decision you can make, and then that really puts you in the best position as parents to help kids in the future. Okay, the second part of Owen's question is that I've only been living in Australia for 2 years, and in other developed places I've lived in, location is more important than land size. So a apartment in a top area is much more desirable than a house a little further out. Australia, which is Brisbane for him, seems to not care about this trend, and people seem to be happy to buy several kilometres away from the heart part of the city for a bigger plot. Will this trend change, and will Australia fall in line with the UK, Europe, etc.? In which case, a central townhouse is a wiser choice than a house on a 600 square metre block 50 minutes out from the CBD. Oh, and you have really hit the nail on the head with this question. It's something I've been talking about for a long time. This trend of property price growth and demand in outer-lying new build areas is a relatively new trend, I would say. Well, no, I would say it really is. I don't have necessarily data to lean on with that, but, I've been running this business since 2002, so 23 years. Wow. And I can say it's only the last 10 years where this situation has really occurred. Normally what's happened in new build areas is that certainly if there's stage land releases, stage one, if you get in at stage one, you'll get some growth, because as the area builds out, the developer realizes that you don't want to release everything all at once. Once there's, some amenities in the area, that stage three, you're going to sell the land for a lot more. There's more profit in it. And so, if you're earlier on in that cycle, you get some growth as a purchaser. If you're later on in that cycle, you're not going to see that much growth. That was the typical trend. But yes, certainly there's been a change in that trend more recently. Look, maybe some of the impact of COVID might be to blame for that. I spoke about that in episode 381 recently. So maybe that's contributing towards the trend. But I don't think the trend's going to persist. And here's why. Because Australia has strong population growth, and really always have, and probably always will have strong population. Maybe not as strong as it is today, but it will still always have a strong population growth. Because of that, we need to, and because we're a very large country in terms of land mass, but it can't be serviced with infrastructure. We don't have enough taxpayers to pay for infrastructure. So that's why most people, most of the population either lives in Melbourne, Sydney or Brisbane, and that'll continue. That's not going to change, unless you were able to build fast trains and all these much better infrastructure to kind of service areas outside of those capital cities. It's not going to change. And there's just not an appetite to build that sort of infrastructure and run it at a loss. For some reason, governments want to run that sort of infrastructure at a profit, and it's not profitable. You can look at China. It's got fast train network. It's got a fast train network, and many of its routes don't actually make money. Anyway, so we're all going to centre in, most of the population is going to be in Melbourne, Sydney or Brisbane. In fact, I just Googled it. It's about 50% of Australia's population just lives in those capital cities. So that's going to continue. And what's going to happen? We're going to spread out as cities. Well, certainly Brisbane and Melbourne can do that. Sydney to a much lesser extent. It will increase its density. But we don't build infrastructure, fast enough and cost effectively enough to be able to service those areas. So living 50 minutes or let's say 30, 40 Ks away from the CBD will just become more problematic. Now, I guess driverless cars will or could to some extent alleviate that, but when will they become mainstream? Perhaps much faster than we might expect, but who knows? It'll go some way, but it's never going to go all the way. So I think I'm not really sure what's driven the trend, whether it has been really low interest rates during COVID or these sorts of things, but maybe incentives around new build property, government incentives, those sorts of things. I'm not sure what's driven that trend, but I don't think that trend's going to last forever. Also, if these cities expand, maybe living 30 Ks out from the CBD is kind of doable, but if we think in 10 years time, those new build properties are probably going to be 40 or 50 Ks from the CBD. At some point, it just becomes too far. So I think quality trumps quantity in terms of land size and so forth every day of the week, and it has in Australia over very long periods of time, but I agree that there's there's been a trend more recently where that hasn't been the case, but I just don't think that trend can persist. Also, what if you're in a suburb 30 Ks out from the CBD, what does that suburb offer that the next adjoining suburb, the new one, is going to offer? There's nothing unique going on, but being close to the CBD, there is uniqueness. There's uniqueness in terms of job opportunities. You can work, one of the benefits of having a office in the city for us in Melbourne is that we can recruit from either side of the city, surrounds. It doesn't really matter that if we had an office on the eastern side of Melbourne, most people aren't going to travel from the western to the eastern side, for example. So there's more job opportunities, more amenities, holidays, better lifestyle, these sorts of things. Anyway, Owen, I agree with your observation. It doesn't make any logical sense. Of course, there's going to be, it's like anything. You go to Paris, there's arrondissements that are more attractive than others, and it's always going to sort of be that way. So I agree. I think a townhouse in a great suburb is much better than a house and land package on the outskirts of the city. Okay, got a next question from Fred. Bit of an interesting one. I'm an avid listener and really like your episode, How Much Wealth is Enough? Episode 358. Which really provoked my thinking. It was really interesting. I've got a lot of feedback from How Much Wealth is Enough. And really what the thesis or the premise around the episode was to work out if you're on track or if you've achieved the level of wealth that you need to live the lifestyle that you desire. And if so, maybe you can have a bit more balance today. So, for those people that, for example, have been working, investing hard for 20 years, they might already be in a position where they're on the track to have a comfortable retirement. They just need a little bit more time to let the investments compound a little bit more. And in that situation, maybe they can take their foot off the pedal in terms of investing new monies and surplus cash flow and go on a few more holidays, for instance. Or maybe people with, a significant amount of wealth can afford to, give away some of their money or help kids or spend a little bit more on holidays and so forth. Anyway, that was the idea around the episode. And what I sort of said is, work out kind of how much money you need. And if there is a difference, then you can think about whether you want to do something with it today. Anyway, so Fred gives me a bit of summary of his situation. He's 57, wife is 56. They're both retired. They've got their home worth 3.5 and a holiday house worth 2.5. No debt against them. They've got a family trust with investments in ETFs, about $4 million ETFs, and there's a debt fund in there. So $4 million. They've got $4.5 million in super, so $8.5 million of investment funds. They like traveling and they spend about $450,000 a year on lifestyle and travel. And they do that, they can't access super yet, so they do that from the family trust portfolio. So spending some of that capital. They've got 2 kids, 25 and 22, and they'd like to help them in the future as well as donate money to charity. And also they've got a Div 7A loan in the corporate beneficiary of the trust. Don't overcomplicate it, but their tax position, it means it's got to pay a dividend to repay this loan. It just means they're paying a bit of tax along the way. So they're not a sort of zero tax environment. It doesn't really matter that much. It's a pretty easy answer for these guys. I think most people are thinking, or most listeners are thinking, okay, they got $8.5 million. They don't need to worry about anything. It's kind of true. I mean, the way I would look at it is to say, if this money is invested, what return can we expect in the long run? And I tend to use, I've spoken about this before, I tend to use 7%. Look, there's a sequence of returns risk in that, at the beginning of retirement, if the market crashes and takes 4 years to recover, then you're really mathematically behind the 8 ball compared to, the first years of retirement is 10% or 15% returns. The compounding impact of that has a big impact. So the sequence in which you get those returns is an issue. That's why I assume 7% in terms of total returns. Now, in Fred's situation, that 7%, that assumption, that return assumption, will be after tax. In Fred's situation, because he's got to pay dividends out of his corporate beneficiary, he might be better off assuming a slightly lower return to account for tax liabilities, even though he's got imputation credits and whatever. So let's go 6% in his situation. 6% of $850,000 is over $500,000. Fred wants to spend $450,000. So he's well in front. If he spends $450,000, chances are his investment portfolio will continue to compound over time. Might not be a straight line, but in 10 years from now, Fred and his wife's going to have more than $8.5 million because they haven't even spent the income and capital. Now, the thing that I'd be really careful here is I wouldn't worry about how much is income, how much is capital. All the investments are liquid, so we don't need to worry about it. We just need to worry about total return, and we want to invest those monies to maximize returns over the longer run as well. And I'd argue because they're in a good position, they can take a little bit more risk, and so having more in growth, which is what they've got, is completely appropriate. That means that they do have capacity, most likely have capacity to, make additional gifts either to kids or to charity now if they would like to. The thing to think about though is that, and I've done this for a couple of clients, is that whilst they're spending $450,000 now, they might not be doing that 10 years from now or even say 15 years from now. Like if I'm thinking like in their 70s, they might end up traveling less. Also find that older clients start traveling a lot less when their kids start having kids as well. So they've got grandchildren because they're needed for babysitting duties and so forth. So, we can take that into account in the calculations. That is, we're not going to spend $450 in perpetuity. That maybe we'll assume we're going to do that for 15 years and then maybe spend, for example, $300,000 in today's dollars. I just did some very rough modeling. So if we spent $450, that increases with inflation, earned 6% after tax. We spent $450 a year for the first 15 years, then reduced it to $300,000 in today's dollars, but future dollars. At 6%, the money runs out at age 96. But then you got the holiday home. You're probably not using both properties. Maybe you don't even have both properties anymore. So there's some equity there. So it certainly shows, even if you're sort of bullish in regards to spending, because you're probably not spending $300,000 in today's dollars in your 80s and 90s. You might be, probably not. It shows that you got some money to utilize, but before now, like in terms of help the kids or help charities. The thing in this situation, when we're dealing with large numbers, you just want to, obviously the risk is that you make the wrong decision. And so if I was in this position, I know I've got a vested interest. I'd have an advisor looking after a portfolio. If I could find an advisor that I trusted and, that I knew was going to do a good job, there really is a lot of value to add for someone that's got $8.5 million invested, in terms of making sure that you reduce risk in the portfolio, but also still expose the portfolio to greater returns, everything I speak about in the podcast, as well as then be able to help that person make really informed decisions, so that if I'm going to give away $500,000, I know I'm not going to do that and put my own retirement at risk. But the only way to really work this out, Fred, is to really do some financial modelling. And then at least if you had an advisor doing the financial modelling, you could have some greater sense of comfort around return assumptions, because then you understand what the underlying risk is in the portfolio as well. But look, it's How Much Is Enough was a really good episode in terms of really great feedback. And I think it's something that certainly the reason I wrote it is I think about these things for myself, and I eat my own cooking in terms of, I've obviously got property investments, I make regular share investments each month, all those sorts of things. And, I'm able to do those things. I then, if I have money left over, we can go have a better holiday, or, spend things on experiences that are going to enhance our life. So we don't look back in 10 years time and go, we should have done more, particularly, while we're healthy. So thanks, Fred. Thanks for the question. I hope that answers that. Okay, I'm going to squeeze in one final question today, and it's from Jack. Love the podcast. Thanks so much for sharing. I'm relatively new to the world of managing personal finance, and you help me so much with the education and all things around money and investment. You're most welcome, Jack. My question is more for a younger, lower earning person. My wife and myself are both 22 years old, don't have huge savings or cash flow. However, we want to start our investment life together, either big or small, steps to help with wealth creation in the future. With that in mind, we've been looking to invest in property, as we feel though with the new updates to the First Home Owners Grant Guarantee Scheme, that could be a good chance to get into the market. However, we're unsure if this is the right strategy going forward. Maybe we need to start earning more, saving longer, or is it time to start talking to a broker, or just avoid property for the moment? We earn $50,000 plus $60,000 annually. We work in a remote location and essentially have no rent or bills to pay at the moment. We've saved $60,000 with 40,000 of that invested at the moment in and returning about 10%, and save about $700 a week. Our monthly expenses around $3,500. Super is invested 50-50 international shares and Australian shares in Hostplus and UniSuper. Thinking of increasing non-concessional by 8% salary sacrifice. Okay, let's go in reverse order. You're 22 years old, so super shouldn't be on the radar. It should be on the radar in so much that I want a good fund that's going to give me high growth, give me good returns, low fees. But apart from that decision, don't worry about it. The extra salary sacrifice can sometimes be worth it if you're working for a university or government institution, and they're, as a result of you contributing more, they will contribute more. But it's got to be compelling. Like if I put in 3%, the employer will put in another 8%. But if it's not that, if it's just straight salary sacrifice, don't bother. Your focus should not be on super at the moment. Your focus should be on building wealth in your own personal name. You've got plenty of time for super. You've got 40 years, 4 decades left to worry about super, so don't worry about that. Absolutely, certainly for a younger person buying a property, which is really, it's not buying property, remember, it's not a property versus shares discussion. As I've said in the podcast before many times, it's a gearing versus no gearing decision. If you're going to borrow to invest, or you think borrowing to invest is a good strategy, then property is the best way to do that. If you want an investment that's ungeared, then shares is the best way to do that. So it's a gearing versus no gearing decision, not a shares versus property decision. And because you're 22 and you've got a very small asset base, the best way to grow an asset base is gearing, of course. We've spoken about that many times. So absolutely, property is the right decision. You want to get into the property market as soon as you possibly can. For a younger person, I would be really encouraging you to buy something that you can manufacture value to, so you can renovate. So buy something in a location that is good as your budget can afford, and buy the worst property in that location in terms of a property that needs a lot of love and care, but hopefully just cosmetic stuff: kitchen, bathroom, flooring, window furnishings, paint, these sorts of things. They're going to add a lot of value. And if you're of mind to do some of that work yourself, that's even better. Of course, you'll kind of bootstrap it and do it at a lower cost. And that way that you're using gearing, that's going to help. You're getting into the property market. Hopefully you're buying well in an area that's going to show good signs of growth over the next few years. That's going to help you. And then finally, the third element that's going to help you build wealth is the value add element. You're going to improve that asset, so you're not just relying on the market. You're going to improve the quality of that asset and the appeal and marketability, and therefore its market value. That's what I'd be doing. So run your own race. I wouldn't worry about what the property market is doing. I wouldn't worry about the government guarantee scheme. I wouldn't worry about any of those things. I would speak to a broker. I would work out what I think I needed to buy a good quality asset, not any property, but a good quality asset within reason. You're not going to go and buy a $2 million property house in a blue chip suburb, of course. You're just starting out. So you want a location that you think is still got some good attributes, maybe not purely investment grade, but still got some good attributes that you can target. And then that broker should be able to tell you, okay, you need to do all these things, that your income needs to be at this level, your savings need to be this level, whatever it might be. And then you've got some targets to work to, Jack. And that's what I do in your situation. For all the Jacks out there, the people that are in their early 20s, that's how I would approach that decision. It's gearing, so it's property. It's trying to buy in think about property cycles like I talk about in this podcast. So, target those locations like Melbourne, for example, that are likely to kick off soon, and then buy something that you can add value to, but cosmetic changes only. You don't want to do structural stuff. Okay, that's enough for today. I think I'll leave it there. Tomorrow, I think I've got an interesting episode for you. I'm going to talk about why relying on property sales data could be a big mistake. So, what I've advocated previously is that we want to invest in areas that have exhibited strong past growth. So it's got the attributes to do that. One way to do that is to look at, past sales of the target property, and target properties similar to that. And I just want to sort of unpack why it's really important to make sure you've got plenty of knowledge behind the numbers. A statistical approach here isn't going to work every single time. Anyway, that's tomorrow. Until then, bye for now. Just a few things before we wrap up, if I may. Of course, you can send me questions at investopoly.com.au. But for a quicker response, feel free to add a comment on the episode's video over on YouTube. We have an Investopoly YouTube channel, and the link is in the show notes. I'm incredibly grateful for the 4.9 star rating on Apple with over 400 reviews. Thank you so much. If you can leave a review or rating, I'd love it, because I'd love to get over 1,000 reviews. That's kind of my target. Keep checking the show notes for free downloads, and I include book discounts there as well. And of course, if you're interested in working with my team and I've included a web link where you can find out a little bit more about what we do and get in touch with us. And of course, until next time, bye for now.